Tom Lee recently has made a lot of bold predictions. Let's take a look.
Since 1987, small caps traded on a median PE basis at a premium to the S&P. The S&P is at 17 times. So I think small caps could, in the next couple years, outperform by more than 100%.
And people want you to answer when I ask you a question. So what are you saying? 60, what 100 on the S&P?
I think well past like 6,700.
No,
sometime next
6,700.
In his latest CNBC interview on November 8th, the Friday, he predicted that S&P 500 will see a 5 to 10% increase by year-end 2024 due to favorable conditions, including dovish Fed and, of course, the new administration. And he also projected that by year-end next year, 2025, S&P 500 would reach 6,700, implying a 12% growth from today's price of $59.95. He has also shared his favorite sectors. He said Bitcoin, small cap, regional banks, and financials are seen as sectors with growth potentials under President Trump. Of course, that's because under Trump's administration, we're expecting him to deregulate the banks, and there will be tax cuts, and there will be pro-business policies. And those policy changes will, small caps companies are very sensitive to those policy changes and will be the major beneficiaries of these policy changes because small cap companies usually operate in a domestic market, facing higher regulatory and tax burdens, and they're lacking the resources that large companies have. Okay, and in terms of small cap potential gain, Tom Lee said the small cap is trading at 10 times forward earnings, so forward PE. And he said since 1987, small caps has typically traded at a premium to the large cap or S&P 500. And S&P 500 is currently trading at 17 times the forward earnings. Okay, so forward PE of 17. And Tom Lee suggests that the small caps would outperform the S&P 500 by over 100%. Well, how is the small cap doing now? So this is the chart of Russell 2000, representing 2,000 small cap companies, both the profitable ones and non-profitable ones. The Russell 2000 broke out in terms of price on November 6th. And that's one day after the election. And it's currently trading at 24.11. So let's do some analysis on Tom Lee's small cap call. Are there any evidence for Tom Lee's call? And this chart shows you the latest data from LSEG at Yardeni Research. And according to LSEG, the forward PE ratio given by Tom Lee on his interview appears to be inaccurate, but that's okay because what's more important is the concept, okay? Because if we take a look, the red S&P 500, which is large cap forward PE, November 8th is at 22.2, the red line, okay, 22.2. And the small cap here is represented by S&P 600, not the Russell 2000, but the S&P 600 PE ratio, forward PE is at 16.7, which is the green line over here. Okay, and the difference between the S&P 600 small cap versus the Russell 2000 is the S&P 400 only captures companies with earnings, okay, only profitable small caps, but Russell 2000 does not. Okay, so right now, if you look at the forward PE on this chart, the S&P 500 is a lot higher than the small cap down here. So the valuation of the large cap is a lot higher than small cap, and that happened right after the QE caused by the pandemic since 2020. Okay, since Federal Reserve flooded the market with the liquidity, the large cap valuation jumped a lot, and there is a noticeable gap between the large and small cap. But what's very interesting is if you look at prior to the pandemic, the red line is actually mostly underneath the green line, meaning the large cap or the S&P 500 valuation, the forward PE is usually lower than the small cap S&P 600 forward PE during the period of low interest rate environments. And do we have more data to back it up? And yes, we do. And let's take a look. On this chart on the to the left, it shows you the current Russell 2000 minus Russell 1000 trailing 12-month PE. So this is trailing PE, okay? And this is comparing the small cap Russell 2000 minus the 1000 small cap versus large cap trailing PE ratio. The difference is currently at minus 9.1, meaning that the PE for the small cap is 9.1% below the PE for the large cap. It's actually at a historical extreme discount for the small cap to the large cap. But again, this one only includes the profitable companies only, because like I said, Russell 2000 includes unprofitable companies, but only profitable companies have a PE ratio, right? And when I say it's currently at a extremely low valuation compared to large cap, if you look at historical data since 1980s, right? So this level is around 1980s, okay? And the chart on the right actually shows you the Russell 2000 versus Russell 1000 relative 10-year annualized return since 1998. This chart implies that right now we're somewhere here, okay? Because Russell 2000 PE is minus 9.1 compared to Russell 1000 PE. Okay, so we're down here. So the implied next 10 years annualized return is going to be 5.6 over here. But this is 5.6% annualized return above the large cap. Okay, this is not the return of the small cap, but this is how much more the small cap is going to do for the next 10 years annualized compared to the large cap. Okay, so this does support Tommy's view. So it does appears that we do have a setup currently favoring the outperformance of a small cap in the future. And that's all I want to share with you today. Do you think the small cap are set to outperform in the future? Let me know in the comment section below. Thank you.